Hello, Internet friend. Today on Value Side. Does anything good come from international trade? I'm David Ravel. Well, on April 2nd, 2025, Liberation Day, President Donald J. Trump presented the world with his list of tariffs to be applied to virtually all the nations of the world. This was the climax of a process that he'd begun a couple of weeks before. He aimed to reduce the annual trade deficit that the United States has endured for years. Quoting now from his policy statement, quote, "It is the policy of the United States to reduce our large and persistent annual trade deficits in goods and to address other unfair and unbalanced aspects of our trade with foreign trading partners." Unquote, the White House. Now, the worldwide reaction was swift and decidedly negative. Financial markets around the globe fell as investors and consumers alike worried about future price increases and potential shortages resulting from the new tariffs. No doubt the president and his administration anticipated this reaction and appeared more than willing to negotiate, to make a deal, in the parlance of the president. Now, the administration's economic advisors, Scott Bessent, Peter Navarro, and Howard Lutnick, among others, agreed with the president's view of trade. It was a two-dimensional transaction in which one side was winning, chiefly China, and the other side was losing, principally the United States. By now, everyone is no doubt familiar with the ongoing public debate over whether this new policy will harm or help our economy, and we leave that discussion to others. However, there is another dimension to these trade transactions that is rarely, if ever, discussed: those trade dollars that return to the United States. A new kind of international trade. Just as 2025 is shaping up to be, 1973 was also a watershed year, one that greatly impacted America's international trade for nearly the next half-century. 1973 saw the Yom Kippur War between Israel and its neighbors, with the U.S. solidly supporting its Mideast ally. It was also the year that President Nixon took America off the gold standards. No longer would dollars be convertible into gold. These two factors precipitated an oil embargo by the Organization of Oil Exporting Countries, OPEC. Led by Saudi Arabia, these primarily Middle Eastern countries stopped selling oil to America. Now, for Saudi Arabia, this was the culmination of a strategy that had been seen that country take control over the massive Aramco oil conglomerate, Saudi Arabia's chief oil producer, and a joint venture between major European and American oil companies and the Sheikhdom. When the oil embargo hit, it was desperate times for the United States, which descended into economic chaos, marked by long lines at the gas station and widespread job losses. Indeed, for the Saudis, the United States was far and away their most significant customer, and an immediate compromise between these two was needed. Now, U.S. Secretary of State Henry Kissinger devised a plan that allowed the Saudis to control Aramco, and by extension, all of the exported oil, but with the caveat that Saudi Arabia must sell its oil in U.S. dollars, what became known as the petrodollar. At first, it appeared the United States was the real loser. After all, American companies had lost control of Aramco, the world's largest oil producer, while gaining very little. However, over the years, the scope of the petrodollar grew and grew. Remarkably, most of those newly minted petrodollars returned to the United States in the form of investments. After all, the U.S. has the world's largest, most reliable financial markets. So while many saw only a loss in Aramco ownership, few realized that many petrodollars would make a round trip, returning to bolster our financial markets. So while the oil companies took the hit, the financial markets gained a new investor, recycled petrodollars. At around the same time that the petrodollar was created, the Nixon-Kissinger team also began trade negotiations with China. While it would take several decades for this relationship to mature, the petrodollar trading model was already well established. And while there were no formal agreements, unlike the petrodollar, the U.S. insisted that all transactions be conducted solely in U.S. dollars. This created a similar recycling currency to the petrodollar. The U.S. paid for Chinese-made goods in dollars, and subsequently China returned at least a portion of those dollars as investments in U.S. treasuries and other financial securities like stocks and bonds. International cash flow. While the U.S. balance of trade, narrowly defined, presents an unflattering picture, there is another perspective that offers a somewhat more positive outlook. It's what economists refer to as the current account, or what accountants call the cash-on-cash basis accounting. The current account reflects both the total money flows into and out of our country. And each month, the Bureau of Economic Analysis prepares the balance of payments report. Now we know that last year, 2024, the United States deficit was $1.13 trillion on the trade deficit. That is, we purchased more than $1 trillion more internationally than we sold. Were there any other transactions last year that we should take note of? And the answer here is a resounding yes. Last year, we acquired more financial assets globally than we sold, by $1.4 trillion to be exact. Our banks gained $25 billion in new foreign loans and deposits. Our financial companies, funds, and brokers gained $323 billion, while non-financial institutions like institutional investors, foundations, and private equity rose by $507 billion. And the U.S. government sold $574 billion in primarily U.S. treasuries of various maturities. Of course, this counterflow of funds and investments did not offset our trillion-dollar trade deficit. The president is correct when he states that we need to reduce the trade deficit to a more manageable level, or ideally, eliminate it, thereby achieving a truly balanced trade environment. However, the U.S. dollar's status as the primary trading currency, read the reserve currency, gives us a significant advantage over all other nations in gaining financial investments and deposits. For China, like our other trading partners, it was simply more convenient to leave their trade deposits and receipts in dollars. Why convert back and forth between the yuan and the dollar when purchasing a U.S. Treasury will provide a handsome return and avoid any exchange risk? The dollar thereby became the default settlement and investment vehicle globally. Now, the next step was for the U.S. to open its financial markets to offshore investors. And this created an opportunity for U.S. companies to appeal to investors that they might otherwise not have reached. A complete new investor entered the American financial markets, and that enriched us. The most obvious example of our new financial strength has been our ability to finance our outsized government debt, a debt that currently exceeds the total of our annual economy and is generally a warning sign. But did you know that foreigners have helped us finance Washington's spending by purchasing 1/4 of all U.S. government debt? Without those offshore investors, it's doubtful that we could enjoy the relatively low interest rates and continued spending of the federal government's plans and programs. If we value those social programs and robust defense and protection, we ought to be more concerned about losing our offshore benefactors. Then there's our stock market, estimated to be currently valued at $52 trillion, by far the most significant financial marketplace in the world. It enables us to finance innovative technology and develop leading-edge products and services. Now, Lacey Hunt, Ph.D. in economics and formerly a Federal Reserve economist, estimates that offshore investors have placed an astonishing $18 trillion in our financial markets, an amount that's more than double their investment in the federal government, and one of the chief reasons we've enjoyed such a positive stock market returns. Add it all up, and to even the casual observer, it becomes readily apparent that the United States relationships in global trade and finance extends far beyond the simple purchase and sales represented by the trade balance. The petrodollar model of returning offshore currency has provided much of our financial miracle that is the modern America. And that's today's Value Side. For all of our articles, references, and podcasts, visit valueside.com. I'm David Ravel. ValueSide is independently written and researched. The views expressed are strictly my own.